Hello and welcome to Fin Know-how's second lesson in the series on financial statements. Today we'll dive a little deeper into that world. As you remember from our prior video, the video that introduced you to financial statements, these statements provide views into the business's operations and financial condition. We got familiar at a high level with the balance sheet, income statement, and the statement of cash flows. So the natural next step is to get into the details of each one of those statements. We will do that in the upcoming lessons, but for today, I would like to take some time to give you some background on the principles and rules that guide the preparation of these financial statements, as well as the ecosystem that ensures they're prepared in a way that complies with those accounting rules and regulations. Let's begin by taking a look at the accounting principles and assumptions that underpin financial statements. So the financial statements are prepared specifically to follow certain rules and assumptions to ensure that they remain reliable, comparable, and useful for decision making. The first of those principles is the cost principle. And what we might mean by the cost principle is that assets are recorded at the original purchase cost, also known as the book value. So it's the original purchase cost, not the current value. This helps in a couple of ways. The information is objective because it can be traced back to invoices or other transaction details for confirmation. And that means the numbers that we have are reliable numbers. It also avoids the need for and the cost of regular revisions to the value. And these revisions are often on a subjective basis. So by relying on a cost basis, you rely on objective information than on a subjective assessment. The downside, of course, is that the values of the on the balance sheet, also called the book values, may deviate significantly from market value as economic conditions change or inflation becomes an issue. Of course, this will be less of a problem for short-term assets and liabilities in a low inflation environment. But the primary thinking behind the cost principle is that you have objective information which can be traced back and confirmed. The second of those principles is the going concern assumption. The going concern assumption is an accounting assumption to identify if a company is financially stable and can meet its business obligations in the long term. It assumes that the business will continue operating into the foreseeable future with assets and liabilities recorded accordingly. So for instance, if we can make the assumption that the business will operate into the foreseeable future, it makes sense to meaningfully identify short-term versus long-term assets and liabilities. If, on the other hand, the business is not a going concern, it can come to an end tomorrow, the distinction between long-term and short-term does not matter. It also makes it possible to record balance sheet items on a historical basis and not have to reassess its value in anticipation of a liquidation. So the going concern assumption implies that there is a long life to the business, which allows for a little more richness and detail about the various types of assets to be recorded, and also allows the reliance on the cost principle. The third principle adopted in accounting statements is the idea of accrual basis, and closely related to it is the detail on how revenue is recognized. Accrual accounting is a method that recognizes revenues when earned and expenses when incurred, regardless of when cash is exchanged. This provides a more accurate and comprehensive view of a company's financial performance and position compared to cash-based accounting, which only records transaction when cash changes hands. On the one hand, it aligns revenue and expenses in a way that it's consistent with when the revenue is earned and when the expense is incurred. But on the other hand, it introduces a disconnect between a transaction that has been recorded as completed when the cash has not exchanged hands. So there is a disconnect between the fact that the transaction is recorded as completed, yet the cash associated with the transaction has not been exchanged. To manage this disconnect, accrual accounting introduces concepts such as accruals and deferrals. Accruals are used to recognize revenue and expenses that have been earned or incurred, but not yet settled with cash. So for instance, if there is work completed but not yet billed, it would be recorded as accrued revenue. And similarly, if you have services received but you have not paid for it yet, that might be recorded as an accrued expense. Deferrals are the opposite of accruals. The cash is received or paid before the revenue is earned or the expenses incurred. Examples include deferred revenue, such as prepaid subscriptions, and prepaid expense, such as rent paid in advance. It is the same disconnect between when a transaction is recorded and when cash exchanges hands that drives the need for a separate cash flow statement to track actual cash movements. You might recall in our discussion of statement of cash flows, I mentioned that cash flow statements are needed because of a specific type of accounting rule, and accrual accounting is exactly that accounting rule. And because it creates a disconnect between the closing of the transaction and the receipt of cash, there is a need to reconcile the two, and the statement of cash flow is a financial statement that reconciles both. Closely related to the idea of accrual basis accounting is the concept of revenue recognition. It deals with the question of when revenue is specifically recorded as being earned. There are many rules regarding revenue recognition under various revenue recognition methods, and these rules vary significantly across industries and sectors. For instance, a business with subscription model, such as software as a service or a magazine, recognizes revenue over the subscription period rather than upfront, even if the payment is upfront. And they do this to provide a clearer view of recurring revenue and performance trend. Or businesses involved in long-term projects or contracts are required to recognize revenue when it is over the period over which the revenue is earned, meaning the contract duration, than solely upon cash receipt. And the idea is to offer a more accurate reflection of ongoing performance. We've discussed three principles and/or assumptions, namely the cost principle, the going concern assumption, and the accrual basis and revenue recognition methods. We will now take a look at yet another principle called the matching principle. The matching principle, again, is closely tied to accrual accounting, and the principle focuses on aligning expenses with the revenue within the same accounting period. So the accrual accounting provides the overall system of being able to record a transaction when it occurs rather than when the cash changes hands. The matching principle, on the other hand, guides when the expenses are recognized in relation to revenues within that system. So accrual accounting allows for a timing difference between when the revenue is recorded and the cash is collected. And the matching principle then makes sure that the expenses that help generate the revenue are recorded in the same time period as the associated revenue. Notice that the matching principle is really not relevant in a cash-based accounting because there is no timing difference, and cash-based accounting is solely concerned with the timing of cash inflows and outflows, so there is no matching consideration that comes into play. The next rule that comes into focus is the economic entity rule. And the economic entity rule requires the business to present financials on a standalone basis. And when you say standalone basis, it means two things. One, the business is present, financials are presented separate from that of its owners. And only the company's activities are included in the statements. So if it is a single owner company and the owner's activities are highly integrated into the business financials will reflect only the activities of the company. The economic entity rule also comes into play when you're looking at a subsidiary of a business. So the subsidiaries' financial statements have to be presented separate from other adjacent or connected businesses, such as the holding company. And the subsidiaries financials are presented therefore on a standalone basis, and the subsidiary being the economic entity in this case. Accounting rules also require that the business transactions presented in the accounting statements are reported in a stable currency, such as the US dollar. The goal here is that this allows for standardized and comparable financial reporting. It is somewhat self-explanatory, so I'm not going to go much more into that. And the last set of guiding principles are consistency, full disclosure, and conservatism. Consistency relates to the idea that once an accounting method to report a financial statement is chosen, that method should be consistently applied across the reporting periods. The goal here is that by recording them using the same accounting methods, you are now able to compare across periods, so to facilitate comparisons. And if it turns out, for instance, that a change is needed, such as in the case of an acquisition, where the accounting method used by the acquiring company is different than the accounting method used by the target company, or due to, say, some accounting rule revision, if that needed to happen, that change has to be disclosed clearly in the financial statements. Again, the goal is to provide the reader with what they need to make informed comparisons and decisions. Full disclosure relates to the principle in accounting that mandates that financial statements should include all information necessary for users to understand the financial position and performance. Idea here is that it's not just the numbers, but there are notes associated with the financial statements to provide the full, a more complete picture. So the details that have to be provided could be positive or negative, but both kinds of disclosures have to be made. And similarly, aside from positive and negative news or aspects, it also has to include potential risks and opportunities. The final principle that we list here relates to the accounting rule that when faced with uncertainty in reporting, when it's not clear what the right number should be in reporting a particular financial statement line item, accountants are required to choose the option that results in the least favorable outcome for the company. This means anticipating potential losses and recording them as soon as they are probable, while delaying the recognition of potential gains until they're virtually certain. Right? So The idea is record in a conservative manner so that the financial results are not overstated. If anything, they should be understated. Now that we have covered the principles, let's look at the organizations that set and enforce these rules and regulations. For guidance on what accounting rules and standards to use to prepare financial statements, accountants look to standard setting organizations such as FASB or IASB. In the US, the entity that sets the rules is called the Financial Accounting Standards Board, FASB. FASB develops the generally accepted accounting principles, otherwise referred to as GAAP, GAAP, which serves as the foundation for financial reporting by US public companies and even private companies and nonprofits. The global counterpart of FASB is the International Accounting Standards Board, IASB, and their version of the rules is called the International Financial Reporting Standards. And this is the rule book followed by many countries worldwide to enhance transparency and cross-border comparability. Now, because FASB and IASB are two different bodies, as you can imagine, the rules are different too. And the rules being different makes life hard for companies who operate in two jurisdictions. So for instance, if you were to think of a US company with international operations, they would have to record and report their foreign country operations, perhaps using IFRS rules, but the overall company financials, because it's a US headquartered company, might be reported using GAAP set by the FASB. Recognizing this, FASB and IASB have initiated convergence efforts where they try to collaborate to align the standards through a process called convergence. The goal of convergence is to reduce the differences and promote consistency in a global financial reporting system. Okay. So we have talked about the rules, we have talked about this entities that set the rules, and now we're going to turn to the financial ecosystem that oversees these rules and how they're used. So financial markets rely on a sophisticated system of checks and balances to make sure that financial statements have integrity and the confidence of investors. At the core of the system are audit firms. So for instance, the big four audit firms, KPMG, Deloitte, EY, PwC, and even some of the next tier firms like Grant Thornton or BDO and so on, work alongside regulatory bodies like the PCAOB and the SEC to ensure transparent, accurate financial reporting. So what is the specific role of the audit firms? Audit firms conduct what's called independent verification. They do that through the examination of financial statements to provide reasonable assurance that they're free from material misstatements and that they comply with accounting standards. So the first part of it is the independent verification. The second role of audit firms is to evaluate internal controls and identify potential risks, helping companies strengthen their governance frameworks and operational efficiency. The third role is to generate market confidence. By performing their verification and risk assessment functions well, and by validating the financial information presented in the financial statements, auditors limit the difference between the information set of the company and the information set available to investors, making capital allocation more efficient and enhancing market trust. So that's the role of audit firms. And so finally, that brings us to the regulatory frameworks that are used to make sure that the audit activities itself are done well. So again, so you have the rules and regulations set by uh, the IFRS and the GAAP rules set by FASB and IASB. Then you have the audit firms making sure that are validating that the financial statements are in fact prepared according to GAAP or IFRS. And then finally, we come to the regulators or the regulatory framework that makes sure that the audit firms themselves are doing their job. So the two regulatory agencies tasked with making sure that the audit firms do their job are the PCOAB and the SEC. The PCOAB, otherwise known as the Public Company Accounting Oversight Board, was established under the Sarbanes-Oxley Act of 2002 after it was the market saw some significant accounting scandals. The Sarbanes-Oxley, also called SOX, set the auditing standards for public company audit. So when E&Y does an audit, the standards to which E&Y will perform the audit is set by PCOAB. In addition to setting the standard, PCOAB will review and inspect the work done by registered audit firms. And if they do not comply with the standards set by PCOAB, they then enforce compliance through disciplinary proceedings. And recognizing that many companies are global companies and they operate in many jurisdictions, PCOAB collaborates with international regulators to make sure that there is cross-border oversight. On top of the PCAOB sits the SEC, the Securities and Exchange Commission. Security and Exchange Commission is the federal agency that enforces securities laws and regulations and oversees the disclosure of financial information. The SEC is the agency that requires public companies to file audited financial statements. So when you look up a company's financial statement on the SEC website, these are financial statements prepared by the company and as required by the SEC, audited by independent auditors. The SEC possesses enforcement authority against securities violation. And one of the key things they do is to work with the PCAOB to maintain audit quality and capital market integrity. So this brings us to the end of this video. And just to recap, we talked about the assumptions, the principles, the rules under which financial statements are prepared. We discussed the agencies such as FASB and IASB that create those rules and principles. Then we looked at audit firms that ensure that the company's financial statements comply with FASB or IASB. And then we looked at the oversight of the audit firms, the system set up in place to make sure that the audit firms are doing their work according to the standards set by the regulatory agencies. And the two specific regulatory entities we looked at are the PCAOB, which sets the auditing standards, and the PCAOB is managed by the SEC to make sure that the PCAOB works to maintain audit quality and capital market integrity. So that brings us to the end of this lesson. Again, it's the second lesson in a series of lessons in the financial statements. The first lesson was an introduction to financial statements, where we took a high-level view of the three financial statements: balance sheets, income statements, and the statement of cash flow. In this lesson, we looked at all the rules and regulations that guide how financial statements are prepared. And the next lesson, we'll start to focus on the details of balance sheets, income statements, and statement of cash flows. Thank you for your time. As always, if you have any questions, feel free to reach out. Happy to answer any questions you may have um, uh, and during Q&A or at the next lesson. See you in the next video. Thank you.